Hello, I'm Adrian Finnegan, and this is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, inflation is slowing in many countries across the world, but the fight to bring prices down is far from over. Is it about to get even tougher and more painful? Also this week, a flurry of commercial and defense deals between the US and India. New Delhi's economic and diplomatic power is rising, but can it compete with China? Plus, a much-needed financial breathing space for Zambia. The nation's debt deal with China could pave the way for other countries struggling to pay their liabilities. Energy is cheaper and food prices are increasing, but at a slower pace. Inflation is easing in many parts of the world, but it's still higher than the target that central banks would like it to be, despite the most synchronized and intense monetary policy tightening in decades. The world's central bank umbrella body now says that the global economy is at a critical juncture in the fight against inflation. It warns the last leg of that journey will be the hardest. The Bank for International Settlements says that interest rates might need to remain high until 2027. It's called on governments to reduce spending and increase taxes to cool prices. And it's warned that strong headwinds may lie ahead with a material risk of more financial stress. Interest rate hikes were blamed in part for the collapse of Silicon Valley Bank in the US, which led to a weeks-long banking turmoil. So what's tricky about hiking rates? Well, first, let's see how they work. Increasing interest rates makes borrowing from banks for car loans, for example, more expensive. People start to spend less because they'll have to pay more for servicing their debt loans. Demand for goods goes down and prices eventually begin to drop. But that slows down the economy. Central banks are treading a fine line between raising interest rates and not hurting their economies. If they raise them too much, that could push countries into a deep recession. If they raise them too little and not fast enough, inflation could become more entrenched. The US, like many other central banks, is targeting inflation at 2%. It's now nearly double that target. But the Federal Reserve has recently paused rate hikes, leaving them at more than 5%. It says it wants to assess their impact on the economy. Other banks, like the Bank of England, have stepped up their fight against rising prices. The UK has increased rates 13 times since December, taking them up from near zero to 5%. Britain's inflation was stubbornly high in May at 8.7%. The European Central Bank has recently raised rates, but only by a quarter percentage point. They now stand at 3.5%. The Eurozone area has already slipped into recession, but the ECB says it won't be able to announce rate peak anytime soon. So why has it been so difficult to rein in inflation? Well, to answer that, we're joined now from London by Viraj Patel, an expert in international monetary economics. Viraj is the global macro strategist at Vanda Research. Good to have you with us, Viraj. So then, why does inflation remain so stubbornly high?
We've had a really sort of unique, I guess, couple of years, right? When you think about the post-pandemic situation in terms of the supply shocks that we've had as a result of that pandemic, but then coupled with the reopening effects that we're seeing from the demand side, it is really unique, something that we haven't seen for 30, 40 years, I guess, or ever really in the macro landscape. So I guess not just central banks, but investors, analysts, we're all sort of struggling with the idea of this very elevated, sticky inflation. And I would sort of characterize it as what we're seeing is just a series of events and unique events that have happened over the last 2 to 3 years that are coalescing in really permanently high inflation. That's making it really challenging because each of these events on their own were almost unpredictable. And I think that's part of the challenge right now is just trying to figure out, okay, at what point do we get back away from sort of, I guess, this unusual phenomenon or world that we've seen and into a more normal situation that we're seeing. I think we're starting to see the early signs of that, but still a long way to go before we can call victory on the inflation starting to ease.
So you say it's an unusual situation. A lot of people standing around scratching their heads at the moment. Do central banks actually know how to tackle this issue? Is it their problem? Are governments not doing enough?
No, it's a great question because I think it's a combination of both, right? Like the idea that central banks have the only tool in the monetary policy toolkit to deal with inflation is wrong. Like, I think that when you look across the world, all the rate-sensitive parts of the sort of markets, the economies, the manufacturing, construction, that is all starting to slow because rate hikes are doing what they're meant to be doing, taking sort of the rate-sensitive parts of the economies down, and those inflationary components are also moving in that way. The real sticking point right now is this sort of services and I guess this consumer element where frankly, rates on their own do not have a linear impact on this. It's fairly binary, right? It's either all or nothing. We're in a recession and services goes down, or we're not in a recession and services remains strong. So, if the goal is to sort of tackle that inflationary element, then maybe we might need to look outside of monetary policy. We might need to start thinking about other ways in which we can, tackle that. And one key way I think governments can do that is really addressing the skills shortages. The reason why we have huge demand mismatches is not necessarily because companies are hiring, it's just they can't get the right workers. So that's one way that governments can help out. There are plenty of others as well.
More tightening to come was the message from top central bankers at their annual gathering hosted by the ECB in Portugal. And they reckon that they can do it without triggering recessions. I mean, is that possible?
I disagree. I mean, I think if you look at the type of inflation that they're now sort of trying to get down, which is really the last mile, let's say, that the BIS called it, which is services inflation, I really don't think that that's the type of inflation that further hikes are going to really do, unless you damage the economy, unless you create a hard landing scenario, a recessionary environment that we've seen, like of the likes of COVID or GFC, etc., that frankly are not what the central banks want. That's the only type of way that we're going to get out that really sticky inflation. So I struggle to see an environment where further rate hikes at this stage are going to do the type of disinflation that they want. Without tanking some sectors, some industries that are very sensitive to rates. So I do think we're in the realm where every hike now is on the verge of a policy mistake, and one where unfortunately central banks have only one mandate, which is bring inflation down. So it's not really their fault, but they have to almost blindly sort of take that policy objective on the sort of chin. And I think that that's the difficult part of being a central banker, where they have to bring inflation down, but they're obviously, not paying enough attention to some of the warning shots that are already out there.
So if rates continue to rise, if economies continue to slow, what's the impact likely to be on the likes of you, me, and anyone watching today?
Yeah, I think that the sort of outcomes are becoming very much more binary, right? Either we're going to be in an economy where it's a lot more resilient. The rate hikes that we've seen in the past are not going to do the same damage that they've done in the past to consumer spending because of socioeconomic factors that have changed since the pandemic. Everyone wants to spend more, go out more, etc. Or it's just increasing the odds of the left tail, which is that we're going to see this all crash and burn to some extent later this year or at the turn of the year. I'm wary of the latter situation. I think that investors may be sort of misguided by some of the underlying strength in inflation and sort of reading that as a strong economy. I see this as very stagflationary. I see it as sort of sticky, supply-driven, idiosyncratic forces that are driving inflation in the UK. Good example of that. And I think that when you look at some of the sort of underlying weaknesses that are stemming, it's only making the risks of a very sort of hard landing coming up. So I wouldn't discount the odds of another SVB crisis, another sort of banking related, housing related stuff coming through in the next 6 months, because that's the only sort of route, I guess, out of this very sticky inflationary environment.
And briefly, all economies are different, of course, each one is unique, but is anyone getting it right at the moment?
Right is a tricky one to get right, because no, I don't think any central bank really has it, inflation fully under control. I do give credit to some of the emerging market countries where they've gone really aggressive, really front loaded in their rate hikes and seem to be sort of, dealing with inflationary forces a bit better. But again, when you think about some of these emerging market economies, they are subject to global inflationary forces, and the supply issues that we're seeing in food and energy as well is going to have ramifications for a long time. So that's the tricky thing with central bankers or any sort of global country right now dealing with inflation. When you have huge external shocks that you cannot control, it's really hard to get it right.
Viraj, it's been really good to talk to you on Counting the Cost. Thanks so much for being with us. India overtook China as the world's most populous nation in April. Alongside its population of 1.4 billion, India's economy is growing fast and its political power is rising too. India's Prime Minister has recently received a lavish welcome at the White House. The US president considers New Delhi an important partner in countering Beijing's global economic power and wants to pull it closer. The two leaders have recently taken their ties to a new high. Joe Biden and Narendra Modi announced several defense and commercial deals during Modi's visit to the US. They include building General Electric F414 jet engines in India and repairing American Navy ships in Indian shipyards. The two nations have also agreed to end 6 disputes at the World Trade Organization and to work together on semiconductors, critical minerals, technology, and space. American and Western companies are also increasingly doing business with India. Apple has expanded production in the nation after suffering supply chain disruptions in China. Air India has bought 220 aircraft from Boeing, the American plane maker's third biggest sale of all time. And European plane maker Airbus has recently won the biggest plane deal with Indian airline Indigo. So can India compete with China? Well, let's take a look at the numbers. China's more than $17 trillion economy is nearly 5 times larger than that of India. But the OECD says that economic growth in India is expected to outshine China this year. The average Chinese individual has an economic output of almost $13,000 a year. It is less than $2,500 for the average Indian. China produces more than half of the world's 5G infrastructure, while India is way behind. Beijing's artificial intelligence firms received at least $95 billion in private investment between 2013 and last year. Indian firms received nearly $7 billion. And 4 of the world's 20 biggest tech companies by revenue are Chinese. None is based in India. Well, from Chennai in India, we're joined now by Neha Anna Thomas, a senior economist and program manager of economic analytics at Frost & Sullivan. Good to have you with us. What do you make of these economic deals then between India and the US?
What we're seeing in summary is that India and the US have recently agreed to a slew of deals in the space of defense, critical minerals, semiconductors, and the like. For example, we can be looking at General Electric's planned investment into the Indian economy to potentially jointly manufacture jet engines in conjunction with Hindustan Aeronautics. We're expecting to see potential inward investments into India for a new semiconductor facility. India has also entered into a US-driven coalition to secure the supply chains when it comes to critical minerals. So net-net, what we see is a lot of collaboration, particularly in the areas of what you would call higher tech, higher value-add manufacturing. And without a doubt, I'd also say that these deals are in sync with what we see happening across the global economy in terms of the decentralization or the diversification of supply chains.
I'm sorry to interrupt you, but collaboration, yes. But what is it specifically that India offers the US that the US can't do for itself?
So it's very important to make a note of the point that at this particular juncture, India is definitely can be seen as a global economic heavyweight, a front runner, in the sense that its GDP growth for the current fiscal 2023-4 is at about 6 to 6.5%. So it's a strong, robust economy to engage with. And it's especially important because this is in a context when Western economies are facing recessionary sentiment. There are fears. The Chinese economy, for example, is displaying signs of uneven growth recovery following the lifting of lockdowns. So I'd say that India has a stable economy. There's a large GDP size that it has to offer, and of course, a lot of demographic advantages that India has to offer to businesses looking to collaborate with India.
Being a little cynical here, isn't what this really is about? Is diversifying supply chains away from China for the US?
In the sense, yes, it is important because of late we have been seeing a trend of what you would call a pivot away from China or China plus one strategies, which essentially mean that just taking a step back following the 2019 US-China trade wars and the pandemic and the Russo-Ukrainian wars, there's been a rattling to global supply chains, and there's been a need to reduce overdependence on China and any specific location. So China plus one essentially means that businesses are looking to maintain presence in China while at the same time sort of expanding or diversifying their footprint across other economies. It's important to make note that it's a China plus one strategy. So China still pretty much remains in the growth equation or the growth strategy just because it's such a manufacturing powerhouse. You have an well entrenched, well developed manufacturing ecosystem,
Yeah,
but countries.
but for how much longer? I mean, how much of a threat does India's fast-growing economy really pose to Beijing?
Right. So we will see that China plus one pivot to India, Southeast Asian economies, and the like, because India stands to gain when businesses are looking to diversify beyond China. Like I mentioned, you have the strong growth potential. There's quite a strong government manufacturing policy thrust in recent years, particularly evidenced by a landmark production linked incentive scheme. So I'd say that India is in a prime time of space to sort of capture some of those investments as companies look to diversify beyond China.
What challenges then is India facing as it gears up then to become perhaps an alternative manufacturing hub to China?
So the first thing that comes to the fore, perhaps, is some of the logistical challenges and the logistical costs associated with doing business in India. So logistics costs as a percentage of GDP in India are typically higher than what you see in some of the other major economies. And at the end of the day, of course, this affects your export competitiveness, your trade competitiveness. But in that regard, we do see the Indian government having recently launched the national logistics policy to sort of control and mitigate some of these costs. We're also seeing a lot of mega infrastructure projects to cull these costs. And I'd say that at the end of the day, as you have this China plus one pivot, India obviously is competing with a lot of other destinations, Southeast Asia primarily. So Southeast Asia, for example, received or managed to attract a fair share of investments following the US-China trade war outbreak. The region as a whole, of course, offers competitive costs, and there's the pivot towards higher value add, higher tech manufacturing in this region as well. So India definitely has to differentiate itself while competing with some of these locations.
Really good to talk to you, Neha. Many thanks indeed for being with us on Counting the Cost.
Thank you.
Zambia became the first African nation to default on its debt during the COVID-19 pandemic of 2020. The loans, worth more than $18 billion, have restricted the country's ability to invest in social programs and infrastructure projects. But despite that, China was accused of dragging its feet in talks to provide the nation with debt relief. Beijing denies the allegations, and it's now agreed with other creditors to rearrange the payments. Under the deal, Zambia's public sector creditors have agreed to reschedule more than $6 billion of payments. Private sector creditors are expected to do that too, on nearly the same amount of money owed to them. The agreement will also allow Zambia to receive money from the International Monetary Fund. French President Emmanuel Macron's government helped to make the breakthrough at the Global Finance and Climate Summit in Paris. Zambia's president hailed the deal as a significant milestone. But Hakainde Hichilema said that the hard work isn't over yet. In a statement on Twitter, the president added that the debt restructuring agreement will be a game changer, leading us towards sustainable development, prosperity, and economic sovereignty. But some politicians are worried that reforms required by lenders will hurt Zambians who are struggling with rising prices.
The measures that the IMF and whosoever are going to put in means that we've taken away subsidies, and this has really hurt the common man. You know, they are complaining of the cost of living.
Joining us now is Herrick Mpuku from Ndola in Zambia. He is the executive director of the Zambia Institute for Policy Analysis and Research. Herrick, good to have you with us. Herrick, how beneficial will this deal be for Zambia's economy? What are the challenges that lie ahead?
Well, you know, the Zambian challenges are pretty immense, but this breakthrough gives a significant measure of relief because in terms of the fiscal position of the Zambian government, it has been pretty poor. So creating this space, this fiscal space, allows government to appropriate resources and direct them to more productive activities. So the prospects are very good, but that doesn't mean that the challenges are over. There's still a lot of reform, a lot of change which has to take place within the Zambian policy space, and also an adherence to a different policy regime will be very crucial to this success. So in the medium term, I see a lessening of the stress on the Zambian economy. There will be a process of trying to build in stabilization, macroeconomic stabilization, bring down the rates of inflation, stabilize the rates of interest, stabilize the exchange rate. This forms the basis for long-term growth. So once we do that, then we can look forward to changes in the medium to long term. But it's a long haul. It's a lot of work. It's actually a sustained process and perseverance in terms of policy direction.
What, Herrick, does this deal say about China's position on debt restructuring and its willingness to write off debts?
China has always been very engaged with Zambia. They've always been willing to support. But you see, every country has its own decision-making process, its own considerations. But I do get the impression that the Chinese government is very committed to be engaged with Zambia, is very committed to ensuring, to minimize the damage of debt buildup to Zambia, and they're also inclined to support the process of removing the pressure that this debt crisis brings upon Zambia. So I think they're very positive. I think they are, all along, I think they've been keen to discuss this matter. And I think there were a few misunderstandings between them and their Western partners. So, but I think those matters have been resolved. I think these things are dealt with by ensuring that there is an element of mutual respect between the players. And I think the frankness and the openness with which all the parties came to this, including the Chinese, is a reflection of their commitment to resolving the problems of countries like ours.
But is pausing the debt of developing nations the right answer to this? So the outcome of this summit was the agreement to pause the debt. It should surely just be cancelled, shouldn't it?
Well, we found ourselves in a difficult position. We were indebted, and we have very few choices remaining. So there's no choice. Otherwise, you push all these countries into a serious meltdown from which all of us would regret. So it's very important that we pause. But also, as we pause this debt, we must say, what does the future provide for us? What should we be looking forward to? So definitely, we want to avoid coming back to this position of serious indebtedness. It's not a good place to be at all. It's a very precarious and dangerous position, socially and economically. So what is important is to embark on a process of policy reform within the country to ensure that our economies are strong, they're vibrant, they're diversified, they are generating exports, they are minimizing imports, they're expanding their trade balances, but also they are also pursuing prudent macroeconomic policies which ensure that our rates of inflation are low, our exchange rates are stable, and our interest rates are low, so that investment can take place, that economies can grow, businesses can grow, both local and international investors. So there's a need for a certain change of mind, a certain change of approach on the part of governments like ours. Our partners must also look at the challenges that we face and make sure that we are fully supported. One of the greatest problems is that as a developing country, the capital requirements are massive. So borrowing is inevitable. So what we needed to do is say, what are the mechanisms by which we can borrow this money and invest money and use it prudently into productive activities? But also we must make sure that we're also mindful of the need to protect our social sector, because it's the people who drive the economy.
Herrick, it's been really good to talk to you on Counting the Cost. Many thanks indeed for being with us.
Thank you very much, again. Thank you.
And that's our show for this week. If you'd like to comment on anything that you've seen, you can tweet me. I'm at A Finnegan on Twitter. Try to use the hashtag AJCTC when you do. You could also drop us a line. Counting the Cost at aljazeera.net is our email address. As always, there's more for you online at aljazeera.com/CTC. That takes you straight to our page. And there you'll find individual reports, links, and even entire episodes for you to catch up on. But that is it for this edition of Counting the Cost. I'm Adrian Finnegan from the team here in Doha. Thanks for being with us. The news on Al Jazeera is next.